Okay, today I'm going to talk about prospect theory. Now, prospect theory is a behavioral finance issue that affects traders and impacts in a pretty significant way. This is a field of called behavioral finance, and it talks about how traders. I'm just going to keep it on traders and not everything else that it affects. How traders deal with risk and reward and the relationship with risk and reward in their own mind. And, this seems like one of those psychological issues that as a trader you would, kind of put as a secondary thing. But it's not. It's actually a primary concern and something that, one, you have to be aware of, two, you have to know how to handle. The skills involved in trading are not difficult to acquire. A lot of times you'll see successful traders say it's not that hard. Why are you making it so hard? And it's not that hard. The skills aren't that hard. It's getting around this problem of behavioral finance and applying the skills correctly. And really it goes back to really understanding, one, we got to talk about prospect theory and understanding that relationship between what your brain is telling you to do at a subconscious level and what you need to do from a mathematical perspective, essentially. Okay, so first thing, what is prospect theory? All right, so this is something, an idea that was brought forward by Daniel Kahneman, and I believe it was the late 90s, and I think he won the Nobel Prize for this in the early 2000s. And it arose from a question when academics were looking at something called utility theory. And what they were saying was, in utility theory we say, if something is the best outcome, if a set of behaviors leads to the best outcome, then naturally that's what you would gravitate towards doing. You would always want to do the behaviors, and you would always naturally gravitate towards the behaviors that would create the optimal result. Now, when they looked out in the world, what they saw was people doing just the opposite. Behaviors that created not just suboptimal results, but really the opposite of what they would desire. And they did it habitually. They kept doing it. Why? So to answer that question, that's the question that Kahneman decided to tackle. He went out and figured this out. And what he discovered was that we have a different relationship in our minds between risk and reward. And we are much more concerned about risk than we are reward. And that idea, you'll see this graph a lot, or a graph that looks like this a lot when people talk about prospect theory. And it's really about your perspective about the gains and losses versus your reference point. What's actually important here is this, to think about, is that we have a disproportionately strong response to losses than we do to gains. Essentially, we like gains, but we really don't want losses. And here's the paradox. In your attempt to avoid the pain of losses, you actually will create, in trading, you will create more losses as you try to avoid those losses, or at least the pain of those losses. And to my experience, this problem and whether or not you can conquer this issue is the delineation point between successful traders that trade, that are able to make money consistently, and everybody else. And there's a huge disparity between those two. Most traders will not make money, and it's not a skills issue. If you guys go on the internet right now and you will have and track down information, you'll have no problem finding out all the information that you need in order to be successful as a trader. It's all out there, and it's fairly easy. You may notice that it's fairly repetitive because the same things that work have always worked. But most people who try to implement these tools will come up short. And it's strictly, to my experience, it's strictly this prospect theory issue. All right, so your disproportionate fear of losses will affect your behavior in certain ways. So let's kind of talk about that a little bit. The main thing I'm going to pull up here, now this is a presentation I put together that you're seeing right here for talks that I do on this subject from time to time. So I'm just going to kind of jump around on this thing a little bit, so just kind of forgive me for that. One of the things you have to understand about how money's made as a trader is you're going to see a lot of talk about these kurtotic or fat tails when we talk about market data. It applies to your gains as well. Fairly few trades that you do will count for the majority of your gains. And I would characterize it as, 7 to 10% of your trades are actually of major impact. Now, that's not to say that only 7 to 10% of your trades are profitable. I'm saying only 7 to 10% of your trades have a major impact on your trading. This is the kurtotic nature of the data. When we say kurtotic, it means the outliers, the occurrence of outliers in your trading. Most of your trades will be the result of most of your trades will be for either a small gain or a small loss. If you don't use any stops and don't try to regulate this, a small number of your trades will be large outlier winners, and another small amount of your trades, about 7 to 10%, will be large outlier losers. So as traders, knowing that our trades will distribute in this way, our P&L, our profit and losses will distribute in this way, what we want to do is we want to cut off the left side of this distribution. Okay, so that's when we come in and use stop losses. So some of the basic tools that we're going to use in our trading are stop losses. To get rid of the left side distribution, make sure that the possibility of a large outlier loss doesn't exist. And then the other side of it is we have to target correctly in order to capture the large gains. And what you'll find is, and I'll talk about this in another video where I talk about trading mechanics, if you don't target correctly and don't have outlier gains, then you won't ever make any money. You'll kind of be caught in limbo. All right, so the formula for making money, if you look at this graphic here, is we get rid of the large outlier losses, we capture the big outlier gains, that's by correct targeting, we size our trades correctly, all right? And sizing relates to risk per trade. It's one of the things you really got to worry about as a trader, how much you risk per trade. And sizing will help you survive. Sizing correctly will be critical to you surviving. And then you have to have edge. Okay, now there's only two ways to create edge in trading. Two basic categories would be auto regression or trend trading, trend following. I'll talk about that in another video, or mean reversion trading. Every signal that you've ever had looked at, they fall in one of those two categories. It's either you're either following momentum or a trend following trade, or it's a mean reversion trade of some sort. And there's thousands of variations on a theme that fall into those two categories. So, to be profitable as a trader, we need to use a stop loss, get rid of the left side distribution, target correctly, capture a large outlier, size correctly so we survive long enough to see the distribution created, and we have to apply positive expectancy or an edge. Okay, now, what is the effect of prospect theory on that? Well, prospect theory makes it so that we don't execute that plan, essentially, is what it boils down to. All right, let me give you a scenario here. Imagine you had and tell me if this has ever happened to you guys. You put a trade on, and you have a losing trade. But you don't want to experience that loss, so what you say is, well, the trade went against me, so what I'll do is I'll hold on to it until it gets back to what I paid for it. And sometimes it does come back to what you paid for it, and you're able to get out of the trade. for a flat or for a small loss or maybe a small gain. But sometimes when you do that, when you hold on to it, it just keeps going down. And I'm sure everybody's had that experience. That's one side of the equation. The other side of the equation is that you have a stock that's going up, and it's a winner. So it's gone up 10% or 15% or something. You say, you know what? I've seen these things go up and come back. What I need to do is this time when it pops a little bit, I'm going to take that gain. Can't go broke, cash in winners, right? And then you close it out for a small gain, and then it takes off and it does something big. Okay, and you never saw any of that. This is very common behavior, and it's driven by the fear of loss. The reason why you're holding on to that stock, even though it's going against you, is because to realize the loss is painful. So a lot of people will even rationalize and tell themselves, well, it's not a loss if I don't take it, if I don't realize it. And they'll park, a loser there and just let it sit there. Meanwhile, every time they get a winner, they say, oh, it's up a little bit, I better cash it out, otherwise it could turn into a loser. So I better ring the bell while I still can. This behavior creates the exact opposite effect of what I was showing you here. What you end up seeing is this. This is what we want to do. If we look here, this is the ideal. We use a stop loss, we cut off the left side, we capture the large gains. And that's a trader that's making money. What prospect theory does is this. It has us cut off the right side of the distribution where the gains are. We chop that off and it opens up the left side of the distribution. Mathematically, prospect theory makes us do exactly the opposite of what we're trying to do. So if we look at this, let me pull this up here. What you see here is a kind of a graphic representation of that, of these two charts here. This is what they would look like in the price action. These big impulse moves here, in this case down, here, if I can get it to click, hold on, here and here, those are the outliers. In this case, this is a trader with a prospect theory problem. So what happens to them is, most of their trades are going to be small winners, small losers, right? Maybe they got out for a small loss, or when it went up, more critically in this case, when it went up, they cut it off too quick. Now, the fear of giving back any gains that they make prompts them, or prospect theory forces them to do subconsciously, is sell their small gain, like get out of it and lock in the profit. So what happens is you never have any impulse moves to the upside. If you had a big winner, it doesn't matter because you got out of it early and you never had any impulsive moves to the upside or a strong move in your P&L. That's what we're looking at here. Right here, these graphs is what your P&L would do. But because you allowed big losses to get in there, the impulsive action in your P&L is actually down. So anytime something works out, you never really get a big bang out of it. But anytime something really goes down, and I'm going to generalize and say it's going to be about 7 to 10% of your trades, that 7 to 10% is going to create a large move, in this case down, in your P&L. So what you're doing essentially is you're creating a trend down in your P&L. And it's just that behavior is going to create this look to your P&L. It's just going to go down. On the other hand, a profitable trader, let me see if I can slide this over a little bit. Okay, a profitable trader is just the opposite look. Every time they have a loss, now most of their trades are going to be small gains, small losses, but anytime they would have had a big outlier loss to the downside, it didn't matter because it didn't affect them because they used a stop loss. So the stop loss is in place, right there. Eliminating negative outliers as trades. But whenever they hit a large positive outlier, they realize it. And those large positive outliers are what actually will create the motion in your P&L. It's actually what will move your P&L forward. So really, 1 out of 10 trades will create all of the motion in your P&L, will create most of the gains. There are other ways, and what I'm referring mostly to here is trend following systems. You could see a smoother equity curve, for more mean reversion trading, that sort of thing. Let's not get into that. Keep it more into the issue of prospect theory. Capturing, doing this the right way, capturing those large gains, and that would be this scenario here. We capture the large gains, we get rid of the large losses, should create this sort of look in your P&L. It's pretty straightforward. Sounds really straightforward. Extremely hard to do, I would characterize. And again, it is the delineation point. To be able to do this consistently is the delineation point between success and failure as a trader. It always has been. It always will be. Guys that figure it out, they just get the equation right in their head and they just go ahead and do it. Most people will struggle with this. They just will. And that's why, I think that, the failure rate is something like 90% for traders trying to trade for the first time. And this is subconscious, and your starting point is always going to be from the wrong place, meaning that you're always going to kind of come into it with this prospect theory problem. You have to train your way out of it, and just be able to figure this out, because if you don't, this will always sneak in. It finds a lot of the weird ways to sneak into your trading, and it is a problem for most traders. I've run across very few people that didn't have to overcome this initially. So I would tell you this: if you're a new trader and you're trying to learn how to trade and you're not having any success, this is probably what the issue is more than anything else. So what I would tell you to do is to really look into this and to conquer this problem. It will be the thing that gets you over the top. It's the thing that holds everybody back. Okay, so, and look, successful traders that you run into, that people that are consistently profitable, they've got this conquered. So it's something that you have to deal with. You might as well deal with it right up front. All right, so just to show you how common this is. Most people think that success in trading is about being right or wrong. It's the most common misperception. Trading is a stochastic process, what we call a stochastic process. Just like if we were running a casino, there's a probability associated with the trades. It's not just about you being right or wrong. It's about when you're right, how much money do you make, versus when you're wrong, how much money do you lose. That equation could fall out a lot of different ways. You could be right 10% of the time and make money. As long as that one time out of 10 that you're right, you made a lot of money. And the other 9 times you lost a little bit of money. And any win-loss ratio will work. But it's really about how much you're making when you are right versus how much you're losing when you're wrong. And that's not how most traders, new traders, think about trading. What they think it is knowing what's going to happen next. And it's not true. What you're doing is exercising an edge. And when you exercise that edge in the stochastic process, you will... It's strictly how the math plays out. How right am I, and when I'm right, how much do I make? That's it. So if we look at this first chart here, this is FXCM data from 2013, but it doesn't matter. This is, but it's just convenient. They used to produce, and I don't know if they still do, but they used to produce a lot of data on the traders in-house. A lot of firms used to do this, and I don't see it as much as they used to anymore. But FXCM, this was their, I think, 14 most active Forex pairs. And this is the win-loss ratio. So if you look here, the win-loss ratios vary from, the lowest was 49%, the best was 71%. I'm going to say over the 14 pairs, the average here is about 60% win-loss ratio. So 6 out of 10 times, traders had profitable trades at FXCM. Now, when I show this, say I show this to a group of traders, new traders, typically I'll ask them, it's kind of a trick question. I ask a lot of trick questions when I'm teaching people stuff, but I'll ask a trick question is like, they're right 6 out of 10 times. Do you think they're making money? Everybody always says yes. That's not true. If you look here, we can see that 3/4 of the traders were unprofitable out of this group. Now, that even 3/4 is high. Having 1/3 of them profitable is fairly high. That's survivorship bias, right? So what happens is in this group, and this happens to be FXCM, I believe it's 197,000 accounts. People that lose money come and go, so they leave. And then traders that are making money stay. So there's a survivorship bias in the data. I guarantee you, if you just picked 100,000 people off the street who had never traded before and let them go at it, it'd be more like 90% unprofitable, 10% profitable, because of prospect theory. All right, so in this case, we got about 3/4 profitable. If we look now at what actually happened, in this graphic here, this is pips. The red is average pip and losses, and the blue is average gain in pips. And you can see here there's a big disparity between these two graphs here. The losses are much larger than the gains. So what's happening? Well, this is prospect theory in action here. What's happening is the traders, when they're losing, they're holding on to the losses. They're holding on to those trades, running against them, and they're realizing larger losses. But when they're right, and in this case it was 6 out of 10 times, as soon as it went up in their direction, they sold it. So they were selling quick and they were holding on the losses, which is exactly what we'd expect to see. And that's this right here. So really the way you got to think about this is, again, the mechanics of trading are fairly easy to understand. They really are. And you're not going to have any problem finding the information that you need to create edge. And how do you stop losses correctly? And how to target correctly. All of which I'll cover in future videos if I keep making these videos. And sizing correctly. And that's the 4 pillars of your trading. Sizing, don't risk too much per trade. And there's a formula for doing that correctly. Targeting, you have to get the gains. You have to capture outliers. Stop losses, you have to avoid negative outliers. And creating edge. And there's only a couple ways really to create edge at the end of the day. Mean reversion or auto-regression, trend following tactics. Okay, so what keeps us from doing those simple things? Prospect theory. Your subconscious behavior, your fear of loss, will drive you to not use a stop loss, to hold on to losers, to get out of your trades too early before they're able to make a large outlier gain. And the combination of that ends up crushing your performance and creates mathematically the exact inverse of what we're trying to do. Like perfect inverse relationship between what you're trying to accomplish and what's really happening. Once you get over that hurdle, you're good to go. Okay, good. That should do it.